In this presentation, we will discuss substantive procedures related to payroll and human resources, noting that the substantive procedures are going to be done after the test of control. So our process here is that we're going to plan, we're going to set the inherent risk, we're going to take a look at the controls, set the control risk, and then depending on whether or not we can trust the controls or depend on the controls, we will do substantive tests to some degree or another. In other words, if we could trust the controls, we do less substantive testing. If we cannot trust the controls, we do more substantive testing. The substantive testing is a type of testing that most people would probably think of if you were to think of auditing, say, something like payroll. We're going to go through the assertions of payroll, actually dig into the data of it, actually go out to the business type of activities, pull files, look at transactions, look at documentations related to the substantive testing. It also takes more time, which is the reason we would like to depend on the controls to do less of the actual substantive testing. First, we'll take a look at substantive analytical procedures. So recall, whenever we see this analytical procedures, we're thinking, okay, now we're in the auditing office. You can think of we're in the auditing office and we're comparing numbers. We're comparing things like this year to last year. We're doing things that are not at the client's location, at the business location. At this point, typically, we get the information and we can do comparison and analysis in the office, in the auditor's office. So we can compare current year payroll expenses and accounts with prior years. So we can take a look at the payroll expenses, comparing and contrasting to prior years. And of course, if there's any substantial differences between those two, we would be considering what is that change for. That might be a valid change, but of course, we're going to say there's a big change. Maybe there's something different that happened. Maybe something's not correct. So we want to explain what that change would be. Compare current year's payroll costs as a percentage of sales and industry data. So you would think that we would have some type of relationship between the payroll costs and the sales. And so we're going to have that kind of ratio that we can use as an analytical procedure as well. Compare labor rates and statistics with industry data. So we can look at the labor rates, of course, and consider those with relation to the particular industry that we are auditing for. Compare accrual payroll expenses with budgeted payroll expenses. So we're going to look at the payroll expenses and compare that to what was budgeted to be in the payroll expenses, and estimate sales commissions with formulas and recorded sales. So we can basically check out the sales commissions, if there are sales commissions, depending on the industry that we're in, and see if they are properly computed as well. We're still considering the substantive analytical procedures. Analytical procedures meaning those things we're doing in the office, the comparison ratio analysis, this time for payroll-related accrual accounts. Payroll-related accrual accounts compare current year balances and prior year balances in the payroll-related accruals. So when we think about payroll-related accruals, those timing type of differences that we might have, you would think that they would be somewhat similar to the prior year accruals, because you would think that we would have similar payroll accrual issues. In other words, if you think about the payroll, notice that it's often one of those adjusting type of entries that we do at the end of the year. So if you want to consider in financial accounting, the payroll process and the adjusting entry process is something you want to basically consider. And the accruals for the adjusting entries at the end of the years are something that we're going to be concerned as the auditor as well. You would think that the cutoff at the end of the year would be somewhat similar. In other words, if we pay people basically every 2 weeks, then you would think that the 2-week time period for payroll, which is typically on more of a cash basis or on whatever cycle is easiest to process payroll, given it's a complex thing, will not land completely as of the end of the year. And therefore, we're going to have some type of accrual process to recognize those expenses that should be recognized because work has been done, but for which payroll checks have not happened, payroll has not yet been processed, and that same cutoff kind of situation would happen at the end of the prior year and the end of the current year. Test accrual balances for reassemblance. Now we're going to take a look at those tests of detail of transactions for the substantive test. So now we're looking at the tests of details of transactions. So these are going to be things where we may very well be going out to the business's office and actually testing these details, doing some substantive testing for them. The management detail and then the tests. And it's important when we consider these things to be able to tie these back into the management assertions. We want to think about the type of tests that we would do for payroll, but we also want to think about what it is we're testing for. And so oftentimes, a lot of people, when they test things like payroll or they do go through the auditing process, they know what they need to do in terms of these are just the tests we need to do. And it kind of makes sense that we would need to do them, but it's more difficult to tie them back to specific assertions. Test questions within audit will often ask this specific assertion that these types of tests will be tied to. And the more we can understand the specific assertions, the better we can understand and actually construct, plan, and build, as well as analyze at the audit. Those are the more difficult type of components, the higher level components, planning the audit at the beginning and then reviewing the audit data at the end. So we have the occurrence, the assertion, trace a sample of payroll checks to the master employee list. So notice we're going to the end, basically the payroll checks, something that is going to be recorded, and we're testing to see if that actually happened, tracing it backwards to see if it actually occurred. And then we have completeness, which you'll recall is basically going the other way, because now we're trying to see, is the end result, the financial statements, have those been constructed? Is everything that should be there? How can we test that? We could trace a sample of timesheets to the payroll register. So we're going to go the other way. We're going to say, okay, now let's start with the payroll timesheets, the source document, and then trace a sample of those all the way to the ending component. And that'll give us a sample that those have been complete, that the payroll is being recorded in a complete fashion. Authorization. Test a sample of payroll checks for the existence of an authorization timesheet. So we're going to go through the authorization, the internal control process, and see that the proper internal controls related to authorization have indeed been done through the testing. Accuracy, recompute for mathematical accuracy of a sample of payroll checks. So notice payroll can be quite complex because we're going to have a lot of things involved. We got the federal income tax withholding, the Social Security withholding, the Medicare withholding, the FUTA withholding, federal unemployment tax, and those are just the federal taxes. Then we've got the state withholdings, and then we have the benefits that have to be computed as well. So we want to go through there and we can recompute for mathematical accuracy. Now you would think, of course, once the system is set up, that the mathematical accuracy would be somewhat good, given it's going to be computerized once set up. But we have to test it because the complexity is such that it is possible that types of things aren't put into the system correctly, or the system isn't designed correctly given the complication of payroll. So one way we can do that, recomputation. Cutoff. You'll recall that's going to be like the year-end type of cutoff. Are we in the proper time period? If it's a 12/31 year-end, did we record the proper amounts to the proper time? And of course, with regards to payroll, when should we be recording something in accordance with the accrual principle of matching or expense recognition? We should be recognizing the expense when the work was done. So, and notice payroll is going to be something that, because of the complexity of it, we're not going to run payroll. Typically, businesses won't run payroll on a perfect accrual system. It's too complex to do so. What they're going to do is say, hey, I'm going to probably be closer to a cash basis system, or whatever system I think payroll will run most easily on. And then we'll have to make the year-end adjustments, adjusting entries, or month-end adjustments possibly for the accruals that will happen. So cutoff then is going to be an issue. And again, you can imagine this type of situation and you want to go back to your adjusting entries for payroll within financial accounting to really understand the cutoff issues with regards to payroll. But you can imagine the fact that if we have payroll and we run payroll every 2 weeks and the year end happened to happen on 12/31, it's unlikely that the payroll end of 2 weeks happened to be on that date as well, unless we use like a mid-month convention, right? If we just have every 2 weeks, then a 2-week time period, then it's not going to be landing right at the end of the year. And therefore, we're going to have time periods in which people worked, they earned revenue, but we haven't yet recorded the payroll because we're not going to do it until the end of the time period when we process the payroll, typically closer to more of a cash basis system. Therefore, the normal accrual process we're going to have to do is to say, okay, how much was earned before the cutoff? Say that we're doing a 12/31 year end. How much was recorded before 12/31? How much was earned by the employees? And record that accrual process there. So we're going to have to go through as the auditor and test that accrual process, which can be a bit complex, again, given the amount of information and data within the payroll process. So cutoff. Trace a sample of timesheets before and after period to the proper weekly payroll report. So we can think, okay, let's test the transactions before and after the time period, cutoff date, let's say 12/31, and see if the time is being allocated properly to the proper time period. Now, for large publicly traded organizations, they may have this set up well, and the system is advanced enough that they're actually doing the accrual process within the system. Also, but note that if you're working with a lot of companies, small to mid-sized companies, they may be doing the accrual in some. They may be manually going back in and figuring out what the accrual is as they need to for the cutoff accrual at the end of the time period. So I'll be aware of that. And then we're going to trace the weekly payroll report to the general ledger. This will verify payroll transactions are recorded in the proper period. So let's take a look at that again. We're going to trace a sample of the timesheets before and after the period to the proper payroll report. So we're going to trace the actual timesheets and then trace the weekly payroll report to the general ledger. And if everything was done properly, then we'll be able to determine if these payroll items have been recorded in the proper time period. But again, just note that as of the end of the year, you may have a consideration if you know that the company pays, say, monthly every month, and you know that the end of the year happened on 12/31, and you know when the payroll date happened, then you have to consider, is your system advanced enough that it's making an accrual even though you haven't paid the payroll at that time period? And if it is, then this testing will test to make sure and double check that that is indeed encased, that the accrual is being made properly. If you're dealing with a small company, the answer may quite likely be no. And in that case, you're going to have to think about, well, how do you make the accrual? Did the company make an accrual? Do we have to make an accrual related to payroll for that basic adjusting entry? And then we have the classification. Examine a sample of payroll checks for current classification to expense accounts. So we want to go through the actual payroll checks and see the classification. Now, normally the classification would be something, basically payroll expense would be the simplest type of classification. And then the employee portion of the taxes would be payroll taxes expense. Now, that alone, even if you have a very simple payroll where everything is just basically posted to payroll expense, and then you have payroll taxes for the employer taxes, that alone is complicated enough, because note that many people don't really understand the payroll transactions. So when you think about, for example, payroll taxes, if we in the auditor are testing the payroll taxes, a lot of people will be confused as to what should be in payroll taxes versus payroll expenses. So remember that payroll expenses includes the gross pay, everything that was paid to the employee, even though we withheld payroll taxes from the employee, including federal income tax, Social Security, and Medicare. And that's because the theory is that we're going to take that money from the employee and pay it to the government on their behalf. And therefore, they earned the full gross pay, even though they're not getting it. And then we took some from them as a benefit to them, theoretically, and then gave it to the government. But that's really their taxes that they're paying. And therefore, we don't put that in payroll tax expense. And then we, as the employer, or the business as the employer, then has to pay payroll taxes over and above what's taken out of the payroll check, including Social Security and Medicare and federal unemployment tax. That is going to be something that's actually payroll taxes. That's an expense to the business for having employees over and above the payroll that they have agreed to pay the employees. So that alone is confusing enough in terms of the classification. Then you have classification issues that might be broken out between, like, sales, might be broken out different than the administrative type of expenses. That can confuse things as well. And it gets a lot more confusing within the classification if you're dealing with a manufacturing company. Because then, of course, the people that work within the manufacturing process should be recording their payroll into the manufacturing process as they generate the inventory, and it'll be part of inventory. So the classification you would think would be fairly straightforward, but it can be a bit more difficult even in the most simplified method. And in a manufacturing company, it could be a little bit more complicated as well, because they're not even all going to be expenses in terms of the payroll expense items. There's going to be classifications within the inventory item as the work is done in order to generate those assets, in order to generate that inventory. Then we have the presentation, review disclosure checklist and related disclosures for relevance and completeness. Now we're going to take a look at test of details related to account balances. So now we're considering the account balances first with regard to existence. So the assertion of existence. With regards to existence, we will vouch a selected amounts for accruals to the supporting documents from account schedules for accruals. So when we consider the accruals that are going to be on the financial statements, those are going to be the liabilities on the financial statements. We want to see whether or not those liabilities actually exist. We're going to vouch the selected amounts for the accruals to the supporting documentations that were used in order to generate those accruals from the schedule of accruals. The assertion of rights and obligations. So rights and obligations are the amounts that are represented on the financial statements with regards to the accruals, in this case, the obligation of the organization. Note, when we consider rights and obligations, we're considering liabilities. So we may be a little less concerned, or we're less concerned at least, that there would be intentional misstatement with regards to rights and obligations, possibly a mistake, because it's less likely that the company would try to look worse. So it's less likely they would put, in other words, liabilities on the books when they're not actual liabilities that are belonging to the organization. So we want to review supporting documentation to see that the entity is legally obligated to pay the liabilities. So we want to see whether or not the legal obligation is actually the legal obligation of the organization. Then we have the assertion of completeness. This is going to be more concerning to us with regards to the accruals. So when we consider accruals, we're going to be more concerned, of course, with completeness, because it's more likely, at least if it was an intentional means to look better, they would want to look better. How would you look better? You could remove some liabilities. So when we consider the liabilities, we're concerned with completeness. We're going to look for unrecorded liabilities. We could foot weekly payroll reports and reconcile the total to the general ledger. So we can look at the weekly reports. We can reconcile those amounts to the general ledger. Accounts include payroll expense and related accruals. Then we have the assertion of accuracy, valuation, and allocation. So accuracy, valuation, allocation. Are these amounts accurate, the valued correctly, and are they allocated correctly? Obtain an analysis schedule of the accounts for accrual payroll liabilities. We're going to foot the schedules and agree totals to the general ledger. Agree amounts accrued to supporting documentation, including payroll tax returns. So obviously, when we consider the accuracy, we can get the supporting documentation. We can basically foot it. We can foot the schedule, add it up. We can recompute the schedule. We can also agree all the information that we have to deal with regards to payroll. So note, when you're dealing with payroll, we have the amount that's going to be reported on the tax return. So when the company files their income taxes, they're going to have the payroll reported as an expense. So it's going to be represented as an expense when they report their income taxes. And they're also going to have it in the payroll tax forms that they're going to have to report. Those include things like the 941 payroll taxes, the 940 at the end of the year. So there's a quarterly 941, then the 940s at the end of the year. Then they're going to have to process the actual W-2s and a summary W-3. All those kind of things can be at least reconciled and tied out with each other to see if they match up, see if they line up. Then we have the assertion of classification. So proper classification. Review the schedules of compensation-related accruals to make sure that different accrual types are correctly classified. So when we consider the accrual types, we want to make sure that the classification is properly classified. So we have the short and long-term liabilities should be properly represented as well. So when we consider the payroll accruals, we would think that most of them would be short-term accrual type of activities that are going to be paid relatively soon, but possibly we could have long-term accrual items as well. And of course, our goal here, breaking out for presentation purposes, the short-term and the long-term portions. Then we have the presentation. We're going to review disclosure checklists for relevance and completeness, review benefit contracts for good disclosure of pension and post-retirement benefits, and then we're going to read the financial statement and evaluate that disclosures are relevant and understandable.